Hedge funds spend hundreds of millions of dollars on AI technology every year. They have teams of data scientists, proprietary datasets, and computing power that retail investors could never access. So why am I telling you that you can copy their core strategies for free? Because the fundamental logic of how sophisticated investors use AI isn't secret, and the tools to implement that logic are now available to anyone with a laptop and an internet connection. I want to be precise about what I mean by copy. I don't mean replicating the exact models of Two Sigma or Bridgewater. That's genuinely impossible for retail investors. What I mean is implementing the same strategic frameworks, factor investing, systematic rebalancing, sentiment analysis, alternative data integration, using retail accessible tools that embody the same underlying principles. Let's go through them one by one. Quant funds were built on factor investing, the idea that certain measurable characteristics of stocks predict outperformance over long time horizons. The most durable factors identified in academic research are value, cheap stocks outperform expensive ones over long horizons; momentum, stocks that have been rising continue to rise in the short term; quality, companies with high return on equity and low debt outperform; and low volatility, low-risk stocks deliver better risk-adjusted returns than high-risk stocks. How to replicate this with free tools? Koyfin Screener lets you filter for all four of these factors simultaneously. Set P below industry average for value, 90-day price momentum above 0 for momentum, return on equity above 15% for quality, and 5-year beta below 1 for low volatility. Run this screen quarterly and you're systematically implementing a factor strategy that institutional quant funds have used to outperform markets for decades. Every major quantitative fund enforces strict portfolio rebalancing on a defined schedule. When positions grow beyond their target allocation, they're trimmed. When positions fall below target, they're added to. This counterintuitively forces the portfolio to buy low and sell high automatically, selling the assets that have risen most and buying the assets that have fallen most, on a mechanical schedule. How to replicate this? Use Composer for automated rebalancing or simply set a quarterly calendar reminder to manually check your allocations and rebalance to target weights. The discipline of scheduled rebalancing is more valuable than any stock-picking strategy for most retail investors. Hedge funds pay enormous sums for alternative data, satellite imagery of retail car parks, credit card transaction aggregates, social media sentiment, to gain an information edge before official financial data is released. Most of this data is genuinely inaccessible to retail investors. But sentiment analysis of publicly available text is not. Tools like Seeking Alpha's sentiment scoring, combined with your own ChatGPT-powered earnings call analysis, give you a version of the text analytics that quant funds have deployed for years. You're analyzing the same earnings call transcripts, the same SEC filings, the same news releases. You're just doing it with more accessible tools rather than proprietary NLP models. The edge isn't as large as a quant fund's, but it's real and it's free. Some of the most consistently profitable hedge funds in history, Winton, Man AHL, Aspect Capital, have been built on a simple principle. Assets that are trending up tend to continue trending up. Assets trending down tend to continue trending down. This is called trend following or managed futures, and it has delivered positive returns across almost every market environment including crises. The retail version, use Composer to build a strategy that allocates to assets showing positive 3-month and 6-month momentum, and exits when trend reverses. Apply this across multiple asset classes, equities, bonds, commodities, and you're implementing a simplified trend-following strategy that captures the same basic return stream that institutional funds charge 2 and 20 fees to access. The sophistication is lower, but the underlying logic is identical. The gap between institutional and retail investing is narrowing rapidly, and AI tools are the primary reason why. None of what I've described today requires a finance degree or proprietary data. It requires discipline, the right tools, and a willingness to follow a systematic process. Subscribe for more, and comment below telling me which of these 4 strategies you're most interested in implementing.